Good morning. I'm Gord Long with the Financial Repression Authority. As part of our ongoing series with leading investors on how to invest in an era of financial repression, I have Ira Harris joining us this morning. Ira is a member of the CME since 1977, a well-known global macro trader, and is currently involved with and working with Vine Street Trading. Welcome back, Ira.
Oh, Gordon, it's great to be here. I really appreciate. Wow, this is when I really followed through. This is a very illustrious crowd, people who I follow. I know that you had contacted me today with Eric Sprout. To anybody who trades metals has been Eric Sprout. If you haven't followed Eric Sprout, you've suffered. So it's a very illustrious group. I'm really proud to be part of this. So
yeah, Eric had some hard-nosed things to say about the current environment, but he says, it could go on for longer than we expect, but he does believe it's basically very artificial on a global basis. I want to springboard from the last time we had you on. You've been writing and you've been really stressing for people to pay attention to the flattening of the yield curve. This 1.21, the difference between the 10 and the 2 as one of the ways of measuring it. We're still holding that support line, it seems. Nothing is breaking. What's your feeling that's going on there right now?
yeah, that's interesting. And the one that I've been writing about for really well over a year is on the 210, which I look at the 210. A lot of people like Rick Santelli will talk about the 530, which is great. That's much more to be a speculator's curve. The 210 is the investor's curve, meaning people with a longer term horizon, and they've measured this out over a long time. So they serve different animals. But I have this level at 117.25. Okay, as a trader, that's an exact level. Do I abide by, because I have people who email, it's one, in fact, I just got one once. There's always give and take. And the other day on Wednesday, when the market was really under severe pressure, the equity markets, we broke down for the first time through that 117 and a quarter. I think we went all the way down to 112 and a half to 113. Now that's a positively steep curve. Okay, so that's what I'm talking about. By yesterday, when the stock market started to rally, we were back at 121. Well, 8 basis points on a yield curve move in a major country. We're not talking about where the markets are thin, where you can. That's a pretty significant move. So it honored that 117. Now people were saying, well, went through there. I said, yeah, as a tradable basis, that was a good trade to make for the day. But because it's such a long-term indicator for me, I look at more weekly and if need be monthly. If it were to close under, there'd be a big signal. So much so that one of the people who wrote into the blog said, well, I'm looking at it, I see that, but then you talked about 80 to 85 basis points. Okay, I don't want to jump too far, but if 80 to 85 basis points on the 210 curve would be, over a historical period of time, a fairly significant flattening. Now, why would that be significant today? Because with interest rates at zero, for the most part, 25, the Fed raised their rate to 25 to 50 point at the recent meeting, they have no room to give. Now, what does that mean? And Larry Summers wrote last week, that the stock market, quoting his uncle, he didn't cite him as his uncle, but Paul Samuelson is Larry Summers' uncle, citing that in a very flip comment that Samuelson probably made 50 years ago, the stock market has predicted 9 of the last 5 recessions.
Exactly.
It's a very flip comment. But I'll tell you what, you can't speak that way of the yield curve. When the yield curve starts to flatten, to ultimately invert, trouble looms. Because that's the central banks have erred one way or another, and what was the error? The error was they were too loose, and then they have to get too tight in order to come back, and that's when you see the curve flatten, because the market anticipates slowing growth, if not negative growth, recession on the. And when did we see that last? 2006, 2007. That yield curve, while the Fed was in the middle of, remember, raising rates every meeting, 25 basis points, 25 basis points. I think it was 17 meetings in a row where they drove the rate up to about 5.5% on the Fed funds rate. While that was going on, the yield curve was flattening, and ultimately, before we saw the equity market 6 to 9 months later start to implode, the curve had inverted. Now, people say, well, it's a bad indicator. It's only a bad indicator because I can't time for you what the market's reaction is going to be to it. I can't tell you. I've looked at this for so many years because I've paid the price of being wrongness and failing to understand it through the Bank of England back in the late 80s and early 90s. I've learned a lot, because people always say, well, you cut interest rates, bond rates go lower. Well, I was long the gilts at that period of time and sat through 4 rate cuts by the Bank of England, and all I did was lose money. So it made me really wake up to the impact of yield curves and what they really signal. And the long end has a mind of its own. So that's truly what we're seeing here. But at the zero bound, to use Stanley Fischer's language, to use Young, at the zero bound, there's not the room like we had in 2006, 2007, because when the Fed realized they were too tight, they were able to cut rates quickly. Remember? They raised rates by quarter of a point, but when they started cutting rates, 50 basis points, 75 basis points, 100 basis points, whatever. It was far more severe, so the reaction was far more severe. They don't have room there. When you're at the zero bound, and we heard Stanley Fischer, what they said, I think it was late last week and again early this week, telling that going to negative yields in the United States would be very difficult because of the money market funds. So many things are tied to it. That would absolutely be, if the United States, if the Federal Reserve of the United States went to negative yields, it would be a catastrophic statement that they had panicked. That's my opinion. That is my opinion, that they have nothing else left. The only thing that they have left, of course, is Ben Bernanke's famous helicopter drops of money. But that's why this curve takes on such significance to me. And the 117 and a quarter was the low made on July 24th, 2012. That day is significant because it was July 25th that Mario Draghi made his famous comments about what was going on in Europe, because those curves were flattening tremendously too at the same time. We'll do whatever we take, whatever it takes to preserve the entire Euro experiment. We will do whatever it takes. That was the low put in at 117 and a quarter.
As we're talking, Ira, my screen is flashing a breaking release from the New York Fed based on what's going on right now, where he's quote saying, if the economy weakens further, we would consider negative rates.
Yeah, Bill Dudley speaking. I read the speech before I came on with you, and he's taking Q&A right now.
As we talk.
Said that. Right.
And the market's reacting to it.
Yeah, well, it's trying to. But yesterday, don't forget, when the market was breaking, and then Jim Bullard came on and did a 180 from where he was last time. And in fact, I thought his comment was absolutely preposterous because he had accused CNBC's commentator and really wonderful. He is a very good bottom-up stock analyst, Jim Cramer. Back in September, when Cramer was beating the drums not to raise rates, Jim Bullard called Cramer unsavory because the Fed should not be in the business of propping up equity markets. So the fact that so then Bullard comes and does a 180 reversal from where he was in December with his hawkish talk. Now all of a sudden we said, well, maybe we're missing. His quote yesterday was, well, maybe the inflation numbers are not going to get to where we thought. We may have to rethink the forecast. So, again, that's what saved the curve. It was kind of interesting because the short end yesterday moved more. The 2-year had a nice rally because don't forget, the 2-year yield has jumped up. Well, probably 2 weeks ago, we were about 105 on the 2-year Treasury, and now we're down to, I think, in the 80s because the Treasury was reacting, of course, to the Fed had told us, Stanley Fischer told us, well, the 4 rate increases this year are probably in the ballpark, which you saw the flattening. As soon as they back off from it, it starts to steepen. And I don't know, I don't have the 210 up in front of me right now because I'm not in front of a Bloomberg. I'm just on my trading system. we're hovering at that area. But that's why that 117 and a quarter. And even last January, February, when we saw all the volatility after the ECB did their thing and after the Swiss did their thing, the Swiss National Bank intervened or pulled the plug on the peg, which was market, and the equity markets were really struggling. We saw a retest of that 117 and a quarter area, and then we bounced out of there and probably went back to around 150 as the market started to. So that's why that 210 is so significant for me. And it will, historically, what that would do, of course, is that it would put pressure on the equity markets because it's that signal. But more importantly for me this time, because if we get down to that 80-85 area, which goes back 10 or 12 years as a critical area, I'm going to watch what the metals market does. Because the gold will tell me, if the gold rallies while the curve flattens, it will be telling me that the market is really getting fearful of what Ben Hunt and others have argued, and I have absolutely signed up to that army of thinkers, is the central banks are losing control.
That was going to be my next question. You sense right now that they are losing control and there's a bit of panic starting to slip in? Because I'm looking at shipping rates around the world, not just the Baltic Dry, but the number of ships that are being pulled back into port because they can't afford to be out there on these rates. Rail traffic, truck traffic. If we're not in a recession right now, it's imminent, which has got to be scaring the Fed. Unless they're looking at data I don't see.
Gordon, you know what? There are people. Well, first of all, this has been just a sales game anyway.
Yes, absolutely.
Right?
I agree.
The media and the popular media, CNBC, Bloomberg, that everybody who has paid homage to Alan Greenspan and Bernanke, and Yellen not so much. She has not gotten the pass that those two have gotten, where they think that they're rocket scientists and that they have absolute control of this. Or to use, I'll paraphrase, is there optimal control function here? It's a myth. They have been, because economic analysis it's not rocket science. You cannot, when I talk about science, good science, of course, is the ability to continually replicate the experiment and get the same results. Well, this is not that. I don't care how sophisticated your mathematical models are. You cannot replicate people's responses to it. Nobody said it better than Joseph Schumpeter. With the whole concept, when I read his logging of the Depression, those are really great essays. But when he talks about pushing on a string, what is pushing on a string? It's that, as he rightfully said, I can raise rates to get you to stop borrowing. I can raise rates high enough where you can't justify borrowing because you can't get enough of a return. Paul Volcker, with the great onset of the recession in 80, 81, 82, by raising rates high enough, you could slow the economy. And Schumpeter said, 80 years ago, but I can't get you to start borrowing, no matter how low I take interest rates, if you don't think through your animal spirits and your entrepreneurship to start, because you can't generate enough return. If I can't even generate enough return on the money I borrow at 1%, it doesn't matter. And that's really what pushing on a string is all about. So that's the ability. You cannot replicate the way people are going to react. And yet, when you when you read the mainstream media, when you listen to them, they all want everybody to believe that the man behind the curtain really knows exactly what he's doing. And what this reflects is, no, it's not. And when people, it irritates me when people will attack, it's the mainstream people who are always selling something. They'll come out and say, and they'll say to somebody like Rick Santelli, or they'll say to somebody like Peter Schiff, or they'll say to somebody like sometimes Kyle Bass and people like that. Well, where's the inflation you predicted? Where's the inflation? We don't have hyperinflation, even though we've had rates at these ultra low levels. That's not why gold goes up. I've never believed that. Gold will anticipate it just like stock market anticipates growth. It's always 6 to 9 months ahead of where people are at. We know that. Anybody who's traded the market understands that. Even in the fundamentals are forward-looking. The metals market, especially gold, is based on central banks. Why does it stay at $1,080? Why? Why? What are people? Because they're afraid that the central banks are going to lose control. And what does every central bank fear? They don't fear inflation, by the way, because they've learned from Paul Volcker that you can slay inflation. I can raise rates high enough to stop it. That's what he showed us. And what did that yield curve do then? It inverted, probably to about 600 to 700 basis points, inverted. And then even when the S&Ps were in the depths of, and then they started to rally, even with the curve inverted, because it was anticipating, well, we wrung out inflation, now there's growth. The metals are the haven, because if you really view that the central bank's greatest fear is deflation, and that they will do anything in their power, or not in their power, to stem deflation, you better always own some precious metal. Because it's not the inflation. It's not, well, inflation 6% today, run out and buy gold. It's the fear of the central banks losing the control. And what will do that? It's not the inflation. It'll be the deflationary impact. Because they've told you that is the most important thing to them. That's all they talk about. They cannot allow the onset of deflation. Why? Because as people like bank credit analysts, your organization, your people, it's been a debt super cycle,
yes.
Which means that we're just borrowed to the hilt. And systems built on borrowing from the Chinese now and everybody else, deflation is anathema. Deflation is 30% unemployment because you have everything stopping. So they would rather endure periods of inflation than periods of deflation. And even Rogoff and Reinhardt, in this time it's different. What does he say? Run inflation hotter, because that's the greatest thing to remove the overhang of debt. If you can't restructure, if you can't write it off, because you're worried about the banks, you have to create some inflation. And their fear is that they've been unable.
Precisely our premise of Financial Repression Authority, but they're not going to be successful short term. Yeah, we're in the deflationary part of the curve. We think out of fear it'll change at some point, but we're not there, and you can see that in the velocity of money. What about gold, or rather energy and oil right now? And it continues to fall. That's kind of the black gold out there. What's your views on it, Ryan?
That's a complicated. I think the oil market is far more complicated right now, and I wrote about it the other day, and actually it was very nice of Art Cashin, who I've just started communicating with, even though I've respected him. He's just an old wise hand.
Mm-hmm.
He's just one, and you'll know what I mean.
I
do. He's market savvy, and he picked up on what I wrote, because there's much more to this. Could the Saudis correct this in a minute? Yes. Because they could say we're cutting too, and all of a sudden you see oil. Is it demand or is it supply? This is what we have to do every day. Yeah, they're pumping all out. Is demand contracting? Yes, because the world economies are slowing down. So, but the Saudis are trying to send a message, and I think that and this is, to me, what I view as one of my great strengths, is the ability to see the geopolitical impact on markets. That's what the global macro world to me is. Because you just can't look at the economic, because the economics are all politics. You can't separate them. I'm a political economist by education. This is what I thrive, where I thrive. So the Saudis are trying to send a message here. And I'm not sure what the message is, but they don't like that in the middle, and the way that they've built their whole structure has been based on that they felt comfortable that the United States and the Sixth Fleet would always be there to support them, and that they would, the pivot, if you would, in foreign policy parlance to Iran as they see it has scared them.
Yes.
It's not that they're trying. Listen, if you get the benefit of shaking up Iran, that's fine. but they're sending a message bigger, bigger. And as I wrote in the blog, I think earlier this week, I think it was every day seems like a week now, so I'm a little more confused. But the Saudis, there was a meeting last weekend in Cairo that the Saudis called. Turkey wasn't invited, and Turkey's a Sunni state. So if there's a Sunni, coalition, that's one thing. It was of the Arab nations. And the Saudis were, and it was called on short order, so that was pretty interesting. But the Saudis are sending a message out. And they're upset with the United States here in this shift of policy as they see it and what's been going on. And we are at a critical juncture. So I think that oil is all part of it, just like all of a sudden we're hearing from the Saudis that they're going to do an IPO of Aramco. I mean, they sent it out there as a trial balloon. That has significant implications. They've never gone that route. Why now? And people say, well, they're short of capital. Okay, maybe that's right. So they're going to raise capital, which is actually, if you float Aramco, it's cheaper to raise capital always in an equity market than it is in the bond market. Especially if you want to go raise capital and you say, well, I'll pledge my oil reserve, which of course they won't. If you buy a Saudi bond, in your own mind, you've created a link to the oil, but Saudi reserves are not the collateral for those bonds. That's only a relationship that every bond buyer will draw out themselves. But there's no, I doubt that it says, oh, I'm going to give you, Gordon, you buy this, $1 million Saudi bond, and I'm going to pledge 25,000 barrels, whatever, so that you have, no, you're just assuming that they're going to have the ability to pay based on their future oil revenues. So now they're going to enter the equity markets. I kind of think that's kind of clever. First of all, especially if big Western pension funds and financial institutions buy this. Now you got a link. You can't let me go. It's like one of my favorite scenes in a movie that I love, The Bronx Tales. When, I don't know if you ever saw it, it's with De Niro, it's great. And these guys come into a bar and they want to make trouble. And it's a bar in probably in the Bronx, and it's where it's a mafia type bar, and they're motorcycle guys, and they're coming in, they're wise guys, and the mafia guys, and they start making trouble, and then they lock the door, and they go, we asked you to leave, now you can't leave. So when the Western financial world comes and buys the Saudi IPO on Aramco, now you're in. You're in, because it's going to be so big. I don't know how big it'll be, but it'll be significant. And the Saudis will be telling you, you're not leaving us. We're not going to be hung out here to dry as you shift policy. So these are the things that now make this very interesting to me. And this is all tied into the price of crude oil. Because I think they're sending a message to everybody. And don't forget, nobody suffers right now more in a financial sense than the U.S., who has levered themselves up to $70 oil, $80 oil, through all the funding that was done for all these different energy companies. To me, the Fed has a bind here, and they're not waking. Their models won't reflect it, but the jobs lost in the energy patch are high-paying jobs. So you're going to see, to me, average hourly earnings are going to be suffering. And that's one of Yellen's, of course, key notes is where the wage growth. But just as those jobs grow wage growth, the losing of those jobs, and those are significant high-paying jobs, are going to impact this economy far more than they think.
I just finished with Eric Sprott. We were talking about Canada. We were talking about the oil sands and how it's just crippling Alberta and Western Canada. The loonie has been in basically free fall here as another calm doll. But switching gears slightly, Ira, to China, and I noticed on the yuan, the weakness on the yuan, but I noticed on earlier this week the overnight lending rate between banks in Hong Kong we used to watch the TED spread pretty closely during the 2007, 2008 early stages of crisis. 13.75%. That's almost panic levels. What's your sense of what's going on in China and specific to the yuan?
China is a difficult situation. For anybody who's read my blog for a long time understands that, and anybody when I've been on with Santelli for years, China is a great story. It's a great story. From an academic sense, it's a great story. From a market sense, I don't trust a thing I read out of China. No, and my tongue-in-cheek statement was when they wouldn't allow Google to operate freely, whether that was just to support Baidu as the operating, as a search engine. If you don't allow Google searches to take place, I can't trust anything that you say. Now, that doesn't mean that China hasn't experienced phenomenal growth. Of course they have. But I'm not going to react and trade on their releases because it's amazing to me that this country that doesn't allow free flow of information and data can meet market projections on so many of their data releases. I always say it reminds me of Jack Welch when he ran GE. Nobody could manipulate an earnings report. This is a guy who was in a penny every time of the projected earnings report. I said China's the Jack Welch of the world because they make every report, within a tenth. I said, come on, it can't possibly be. So I don't trust the data enough to trade. When the Australian dollar is rallying and Australia is booming, that's a better indication to me. That's like, Levi Strauss used to say he made more money selling picks and shovels and dungarees to the gold miners than the gold miners ever made. So I can work, this is capitalism. Good capitalism always operates around the margins because that's where you see the real show going on. Just like when you talk about Canada, Canada was discounting oil out of the oil sands well before the price of oil dropped underneath $70. You could buy Canadian oil, because they were discounting it in order to move. So you knew that there was pressure in the oil market. The Chinese are difficult. And now everybody expects them to be, investors want them to be in full control. They want, they know what they're doing. They know what they're doing. They know what they're doing. Oh, they got this under control. We want to believe that because that's, again, like the man behind the curtain with the Fed. We want to believe that this is science. It's not. It's not. Yes, they could be a tremendously repressive regime. And, money doesn't care. As long as you guarantee my return of the money and a general rate. If I'm investing in a dictatorship, I'll invest in a dictatorship. We would like to always have the rule of law. But if you give me a 50-year dictatorship that allows capital in and treats it right, I don't care. Not me per se. I may have but I'm talking about the money markets in general. So they want to believe this. Do they? I don't know. But I know that one thing that will always scare the Chinese authorities, meaning the Communist Party, is if they lose control of the employment situation. That's what it's talking about. So, I agree with Michael Pettis. I like Michael Pettis. I think he's one of the much clearer thinkers. He's not, and he sees it, and he's been calling, he's talked about how the Chinese leadership financially repressed the middle class. Why? Because they kept the yuan too cheap in order to build up this vast pool of reserves. Because when you want to buy imports, you have to pay a greater price. But the engine was to drive the export engine. So then when they were trying to make the shift from export-oriented to a more domestic-oriented, then you want to have a stronger yuan because it aids it makes for cheaper imports. So if you're really trying to empower your citizenry, let the currency go higher.
I sense, Ira, from some of your comments, there is no man behind the screen, either in Europe, the United States, or China, and that they're really just making this up as they go, and strictly reacting to it. Because I think the feeling out there is the central banks have your back, but do they really have the control to even exercise that? Am I overstating that?
No, you're not. I think and I think that's where we struggle. Because we want to believe, markets want to believe in the philosopher king. They want
Yes.
that there's somebody out there who really knows and this is all under control. Well, how many times do we have to be proven wrong that, hey, it's just not the way it operates. It's not the way things are. We want to believe that, but it's not. And in China, it's still a totalitarian government. So they can inspire fear, which is what a totalitarian regime operates on. You're fearful. You're fearful for one of a number of things. But the fact that they basically have, up until the point of when it all falls apart, like we saw in the Soviet Union, back to Russia, but when you're a totalitarian regime, you basically have a monopoly on violent reactions. So and that keeps people in line. So is that what people are banking on? I don't know. But if unemployment grows significantly, especially because you moved so many people off the farm, out of rural areas to the coasts, they have enormous population shift, and we know that's never an easy thing for any developing country. And China has done it so fast. A big part. You talk about the capitalist development of a country. All right, the United States had the agricultural revolution, which drew the capital, which was huge, but it was a process of what, 100 years, 120 years. We still, World War I and World War II, we probably saw the greatest migration out of rural areas into the factories as the country geared up for war, and they needed, there were factory jobs. But most people were still living, an agrarian type existence. Yes, we had great, agricultural production, but it was a process. China has, it took us 120, 130 years to do, they've done in 20 years, 25 years. That's a massive ripping of the fabric of any society. So that's what they have to hold together. What will they do to hold it together? Don't know. But are they having a problem? Of course, they've made the classic mistake when money is cheap, and we can argue all day long why it was cheap, that they built so much excess capacity. So now which is why they're trying to make that shift from export-oriented to more domestic, because they need to utilize all that capacity. And they can't take they're kind of like they can't take a slowdown right now of any type of portion. Japan was able to muddle through for 20 years because the rest of the world was growing. As bad as it was in Japan, it was still, they could muddle through, even with the yen going to all-time, highs. The yen was a super strong currency, which would ultimately hurt them fairly dramatically, but they were able to live off the growth in the rest of the world. They had to fall, when Japan went into its period of downturn, the Berlin Wall had come down, Eastern Europe was on the rise, you had growth in Europe, you had China emerging, you had Russia doing better, you had India starting to come, Brazil and Latin America. So you had great global growth story underneath it. Now we're afraid because there is no global growth story.
I don't see it, and I travel the world uh, with interviews and people who do know and are on the ground, and it's not there. And one of the issues with quantitative easing is everybody talks about bringing demand forward. It did that initially. It exploded supply, and the loss of pricing power that I see that's coming with it, et cetera. We have to wrap. Ira, are the things that you're going to be watching in the next 60 days to really tell you, besides the 210 and maybe some precious metal reaction, but are there some key things investors should be zeroed in on right now?
Well, you know what, Gordon, it used to be so much easier to see this, but because of the algorithm and things happen,
Yes.
correlations that it used to take me months to do, and now happen in seconds, minutes, hours, days. So we don't have the play out of fundamentals like we used to. They will eventually play out because fundamentals will ultimately drive the market. You have to return to fundamentals.
You hope. There are times where I wonder if that will happen, but yes, historically it always has.
It always has. And you know what? Again, as you know, when you watch the IBM commercials with Watson are great. And it took me a while to really understand why I thought they were so great. But when you have Watson say to Bob Dylan that he read all his music and then, oh, I can read 800 million pages in a X amount of time. And then he looks at Bob Dylan and he goes, oh, and I can sing. He says, you could sing? He says, yeah, do up, do up, do up. He can't sing. He can correlate and he can, but he still can't sing. So that gives me a sense that, yes, the fundamentals will bear out no matter how many algorithms are driving this, because it'll be short term and it's percent, and then everybody will turn around and go, what is here? What just happened here? You know, just like 2006, 2007. It looked like housing, you know, and even Ben Bernanke famous, this is subprime, it's under control, it's not that big a deal, until it was a big deal. So what I'm watching the metals, I'm watching the curves as an indication. The equity markets, because they're so linked now, tell you the global story. I think that linkage is one of those false correlations, but that's what the markets are right now. So, you know, it was interesting, and as I blogged about in late December, we are closing out the year, meaning December 2015, with all the major equity markets closing underneath the 200-day moving average. That was pretty significant because some were trying to hold it, they couldn't hold it. The S&Ps tried to hold it, the US until the last hour of the last day of the year. And then where everybody was expecting a late rally, didn't hold it. That was a fairly ominous sign to me. And we see, you know what, there's a lot of money sloshing around. It's still not fearful enough yet, so I know we'll get more sell-off. Are we close? Yeah, I don't know. Again, there's an awful lot of people hoping that they can hold it together. We'll see. I'm not sure. I'm not sure, but everybody certainly wants to believe in the pseudoscience that they put out there is that they have control, and it's not. Listen, financial markets, thank God that, you know, money's allowed to flow and it can seek out, and there's entrepreneurial spirits. Thank God, because that's what capitalism really is. It's not about fixing interest rates, because that's always the last stance of people who think that they can control this. You're not going to control it. You can pretend, and you'll get enough support, you know, until all of a sudden everybody turns around and go, uh-oh, they don't know. They don't know. And that's what they have to be very, because we've all been sold the bill of goods that they know exactly what they're doing and that their outcomes are predictable. All I know is when you send the rocket up, they put a man on the moon, although my grandmother, till the day she died, didn't believe it. She thought it was all Hollywood, even though I sat and watched it with her. But she was from the old country, and maybe she was right. Maybe the wisdom of our grandparents was right. But she said, oh, it's a phony. But all I know is they put a person on the moon. The person got back in a capsule and came back, and they were able to pick them up. And to see, that's pretty good science. I've yet to see that in monetary policy. So again, monetary policy and financial acumen is still not rocket science. So we'll go back and forth.
Our absolute pleasure. A lot to think about for our listeners on the subjects you addressed here. We're going to have you back on a more regular basis because you've got so, as all of this starts to unfold. Can you tell our listeners how they could follow your writings, your blog, and more about Vine Trading?
About where? Vine Street?
Right, by Vine Street, absolutely.
Vine Street is just a group of guys who started out reading my blog. They're global macro guys. They're not high-frequency traders. And we sit and I work with them because they really respect the work and know what to do with it. Because it's not easy to think long-term but try to trade within a window. Because you can see these things and it takes time for them to pan out. But we try to catch things on a much shorter-term basis. So it's a very small operation at this point in time. They've done very well. While others have struggled, they've been very, very good traders over the last 6-7 years. Thinking about maybe doing a fund because they can do it well and they're really good risk managers, so I like working with them. But it's nothing more than that. And that's not to say that it's nothing, it's a lot. Because to exist and thrive as they have done it in these turbulent times says a great deal. They're good risk managers, and yet they're good analysts at the same time, that's a rare commodity. If you want to follow the blog, you should go to iraharris.com. Notes from Underground will pop up. Click on it, and there's a place to register, and it's free. And the greatest pleasure for me is that I get to do my thinking out loud. If you can tell what my political views are from reading the blog, I failed, because that's not what it's about. It's about trying to do the best in helping people understand what's going on. I don't tout trades per se. I just give levels where I think you should pay attention. I always tell people you have to do your own technical work, because I'm not in the business. If you want to pay me a lot of money, I'll put together trades for you with buys and where I think you should buy and sell. That's not what this is about. This is helping you, as my touting of the rotten heart of Europe, as I always like to talk about. It's about teaching you and giving you the tools so that you can see through. And you know what? Because finance is a gray area. It's not black and white. So you have to be able to read between the lines as to what's really going on. Just as what you guys are doing. Because I've gone back and watched a lot of them. And that's what you try to do. You try to enlighten people.
Exactly.
So if you click on Notes from Underground, which is, of course, it's a way to me to pay homage to the great Fyodor Dostoevsky, who wrote the wonderful book, Notes from Underground. And, or I'm not sure what a short story, but for him it's short, but for most people it's a full book. And that concept of not being reliant on the great rational. It's not science. It's some science. It's mathematical model building, which is aggregating data, which is good. It's just another tool, but it's only a tool and not the being and end all. And that's what I try to get people to understand. And I try to point you in certain ways so that when somebody calls you, maybe soliciting your business for, to open up with them, you go, that's not true. I've looked at this. You're giving me mumbo jumbo. So I want people to be able to see the mumbo jumbo so they can manage their wealth in a much more efficient way.
Well, I think you've done that today. Certainly your goal of enlightening and broadening people's education and helping us kind of pull these things apart. I really appreciate it. Ira, we'll talk to you again, and let's hope 2016 turns out to be a great year for you, I, and all of our listeners.
It's a pleasure. Absolute pleasure.
Talk to you again.
Keep doing the good work.
Thank you very much. Bye-bye.
Okay, pleasure.